welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate all the support and the comments and the subscribers. It's been an amazing 2020 as we come to the end of the year. Today, we're going to look at PayPal. We're going to go through the financials. We're going to look at their cash flow, their balance sheet, their earnings. We're going to come up with what we think the business is fundamentally worth. Then we're going to look out in the market to see what is it trading at, and is there a difference? And if that difference can be realized, that's our economic return. This channel is dedicated to the cash flow investor, the fundamental value-based analysis, and we believe that the underpinning of all investment is cash flow, that is the foundation of all investment. And here we look to find that cash flow and look for stocks that are producing cash flow. Today we're going to look at PayPal, and as always, we're going to go through the 5 key attributes for all of our investments. The first one being top line revenue growth, must have it. Second one, earnings growth. We used EBITDA as our earnings metric for enterprise level earnings. We need strong free cash flow. We need a balance sheet that's well positioned. That means low debt, less than 3 times debt to EBITDA. And finally, the stock must be well priced. As an example of that, please check out my Domino's versus Google IPO video where we looked at 15 years ago where they both IPO'd the same year. And Domino's actually outperformed Google over that time period because you could have purchased it so cheaply when it IPO'd. Those are the 5 key attributes. Now we're going to dive into PayPal, take a look, and see what we think. So their annual report filed in December of 2019 is behind me. Obviously now we're approaching the end of 2020. There's 3 quarters, almost 4 quarters of information that's not in this report. So we're going to go to their Q3 2020 earnings report, get an update, a smell check of what we think 2020 is going to look like, and then we'll come back to the 2019 annual report and we'll pull the rest of the material. Okay, behind me is PayPal's Q3 2020 report. Let's go through and see what we think of these numbers. So the very first slide, I'd like to point out one thing that I look for is when do they bring up cash flow? And you can see right here at the very bottom of the very first slide, free cash flow for Q3 of 2020, $3.9 billion. That is year-to-date cash flow. And I want to congratulate the accounting and finance team at PayPal for bringing cash flow front and center on the first chart. What I say when I always look at these investment documents that are published by companies, they are marketing materials, first and foremost, remember that. And they position themselves the best as possible, the best light to attract investors, right? If you don't have free cash flow, you talk about sales. If you don't have sales, you talk about customers. You don't have customers, you talk about tangible addressable market, the TAM. But PayPal has a tangible addressable market. They have customers, they have revenue, so they focus on cash flow. Good for them. Okay, let's keep going and get a smell check of where they are in 2020 that we'll use as a guidepost for setting our benchmark for 2020 EBITDA. And I could do that by kind of zipping through this presentation and look at slide 21. So here at slide 21, you can see behind me the full year guidance for PayPal. Revenue growth growing at 20% a year over year, and non-GAAP earnings is 27 to 28%. Non-GAAP here, they say behind me that there's been some COVID adjustments. They've taken some loss write-downs in preparation for people who aren't going to be making good on some of the credit that they extended. So that's the non-GAAP adjustment that they're showing. But it's saying year-over-year earnings are going to grow 27 to 28%, and that's with 3 quarters already booked in 2020. So all you're doing is guessing at another 3 months of earnings. So this number to me seems rather certain. So we're going to go ahead and use that when we go forward for 2020 and around a 25% annual growth rate from 2019 to 2020. Okay, the next thing I wanted to talk about is some of the markets that they address. PayPal over the years has purchased has acquired either organically or through acquisition a number of facets of digital commerce that are extremely important to their business and I think underpin a lot of the value here. First off, obviously the PayPal network itself, which was initially just a payment button when they spun out of eBay, and they have grown that into a whole portfolio of commercial transaction capability. Mainly Venmo would be one of the big ones that they own. They own Braintree, which is a lot of the digital commerce is done on Braintree. They own GoPay, which is a Chinese. It's a transaction-based app that's used in China for them. They own other companies like Honey and so forth that they've made acquisitions, and they have kind of a portfolio that is extremely impressive. And in this document, they look at active users and total transaction value as their metrics, and we're going to look at that as historically to see what they've done and where we believe they're going to go in the future. But highly recommend you check out the Q3 earnings. Let's go now to the 2019 annual report. So here it is behind me. This is their annual report, and inside the annual report is the 10K that we look for. But you should go through and read the message from the president and CEO. It sets the tone for the document. Certainly at the end of 2019, they had a phenomenal year, so it's very flattering. I'd expect they have another amazing year in 2020 as well. So let's take a look at the cash flow balance sheet and income statement, and that's on page 164 of the filing. So you can see behind me is the balance sheet as of fiscal 19 ending December 31st. And one thing that I really like is the amount of cash that they have on hand. Okay, they have $3 billion, $3.4 billion of cash. That's excess cash, and we're going to exclude that from our enterprise value. You'll see that in a second. But outside of that, just in the bank, they have $7.3 billion of jack sitting in their checking account, essentially checking account. That's a lot of cash. And I look at the total current assets, $38 billion of total current assets. Cool thing here, if I zip down and look at total liabilities, $34 billion. So their current assets exceed all liabilities. That is a great accounting check. That's a great smell check to make sure that they're not carrying too much debt. So I have a feeling this is going to check the box for debt right away. But great smell check. Let's go to the income statement. I'll show you just some of the features of the income statement that I really like. First off, it's super clean, really, really an easy to read income statement. Top line net revenues, $17.7 billion of top line revenue. To be honest, I was really surprised how large this is. This puts it in line with Visa. Visa has about $17 billion of top line revenue. So PayPal is kind of a neck and neck with Visa, means it's a huge, huge player. They've got their cost here, fairly self-explanatory. They delineate them nicely when they bucket them. And they made $2.7 billion of operating income by running their business and transacting. And we'll pick this number up when we do our EBITDA calculation, basically taking this number, adding to that the depreciation amortization, and you get a real close number for the EBITDA that I have. The other thing that I want to point out on this statement is the outstanding shares. So here, weighted average shares outstanding. When we talk, when they talk about EPS in their document, earnings per share, EPS growth, that is a combination of two things. It's a combination of natural growth of the P&L, this number here, this operating income growth. But because they put it on a per share basis, if I reduce the shares outstanding, that makes the denominator go up, or the resultant go up, and that is another way of boosting earnings. If this number here is flat, I can buy back and cancel shares, meaning this denominator is lower. You divide a flat number by a lower number, you get an increase. So when I look at EPS, it tends to be manipulated by the share count. That's why I remove it. And I look at EBITDA, which is natural, full level earnings of the business. Then if they can reduce share count, all the better to me. But I want to make sure that this here is growing before I even took it share count. And that's growing for sure right here. Last thing, let's look at cash flow. That's where the rubber meets the road. It's my personal favorite statement. Right, the top, we've covered this in the past, the top third is your operating results. This is cash flow from operations. So they made $4.5 billion of cash, hard money from operating their businesses. They put another $5.7 billion back through investments. Most of this is right here for purchase of investments. That's like they're investing in their cash. Really, you're looking for this $700 million, which is the CapEx piece. And then the final third of their cash flow statement is the financing. What do they do with debt? What do they do with the equity? Are they paying a dividend? Are they buying back shares? That's in this section. So 3 statements to the cash flow statement: operating, investing, and financing. All of it looks pretty clean to me, but let's go through and take a look at the numbers over a long period of time and see what we think PayPal is worth. PayPal, we're going to start at revenue. And these numbers PayPal's been around for a long time, but they were owned by eBay and they were spun out in 2015. So I don't have a lot of historical information because they weren't public. They were public way early on, then they were bought and recently spun out. So I've got about information through 2015 to present day. Some historical on revenue can work. So revenue, top line revenue has been growing. It's been growing nicely, $5.6 billion to $17.8 billion over this 7-year period of time, which is an 18% annualized growth rate. Fantastic. Definitely checks the box on revenue growth. Strong double-digit top-line revenue growth is a great way to start on when reviewing an investment opportunity. The next one is EBITDA. Again, EBITDA is our metric for whole company earnings, and that is growing as well. $1.1 billion to $3.4 billion of EBITDA in the last fiscal year of 2019. That is a 16% annualized growth rate, which is very close to revenue. A little weaker than revenue, but no problem. It's still solid double digit to revenue. So I think that also checks the box to earnings growth. So we got top line earning growth and we have top line revenue growth and earnings growth. Let's take a look at enterprise value and debt, see where they stack up. So to get enterprise value, we're going to begin with debt, and you can see debt's zero for quite a long time. They just recently borrowed $5.4 billion. It's the first blip you see here, but that's going to be a drop in the bucket when you see it in a second. Excess cash, they put it as a marketable security line on their balance sheet, and I'm just pulling it. We're going to remove that because it's not part of the enterprise value of a company. It's cash that has built up from prior period earnings that should have been dividend out or should have been used to buy back shares, but wasn't. And if for some reason the business were to be acquired by some bigger entity, the existing shareholders would ask that this money is sent to them before they sell the business. That's why we remove it from here, because it's not part of the ongoing operating value of the business. It definitely has value, but if you were to sell the business to a third party, or for us, that's the way we look at it, the existing shareholders would say, give me that cash now, then sell it. So we remove that. Market cap, outstanding shares times average price for the fiscal year end month. This would be December, and I get a market value. I add the debt, less the cash, add the equity piece, and I get enterprise value. That is what the entire business is worth. That's the number we look for. And you can see, as of 2015 to 2019, again, because they were spun out of eBay in 2015, they have gone from $41 billion to $127 billion of enterprise value. Recently, however, it has really spiked, $253 billion of enterprise value. That's a monster jump for 1 year to go from end of 2019 to now. This is as of December of 2020. But let's take a look at our value metrics. We're going to do the first one, debt. Net debt to EBITDA, it's easy, it's zero. It's 0.6 recently, but when I take the debt less the excess cash, it's almost zero. So that checks the box on debt, it's zero. Enterprise value to EBITDA. This is our well-priced metric, and you can see here that you've got, you can see here it's averaged about 25 times enterprise value to EBITDA. It's now trading at 60 times forward or EBITDA, which is pricey, very pricey, and we need to consider this when we're going to look at the business. And we'll come back to this in a second, but it's definitely not cheap. Let's take a look at something else. Now we need to assess how to look at this business and what kind of growth do we use and how do we forecast it. So I want to understand the business a bit more. So I put these metrics. These metrics are what PayPal puts forth in their 10K as kind of fundamental metrics that they look at, and these drive revenue and these drive earnings. And that would be active accounts. So they went from, in 2015, 179 million active accounts to recently 305 million accounts. That's a monster move, and that's a solid double-digit annual growth rate from the active members, and that's underpinning revenue, and I think that's why you're seeing revenue be double-digit. The next thing is total payment volume. right? These guys are a payment processor. Braintree processes payments for online e-commerce websites. PayPal is a payment processing button. Venmo is a payment transferring process. GoPay, same thing. So all the money that transacts in their network, they're getting little fees on, little nickels and dimes and fractions of a cent as this money washes through their system, which is a great position to be in. So not only does it matter about the number of active users, active accounts in their network, but then how much money are those people transacting with? So there's two facets to this. It's how many users they have and how much volume of money are those users circulating, kind of the velocity of money, if you will. And you can see that has grown substantially as well. 281, these are billions, these are millions, this is billions USD, 281 billion to $712 billion ending 2019. That's $750 billion that's moving through their network that they're pulling off pennies from. It's amazing. And that is a strong double-digit growth rate every single year, 25 to 30%. Incredible. And this is what's driving the revenue growth. You saw revenue growth that was upwards of 18%. Well, that 18% is obviously higher than their account growth. That's because not only are the user accounts growing, but it appears to me that the volume of transactions that each user is then doing is increasing as PayPal gets a larger piece of this customer's wallet. The number of payments, the dollar amount of payments is growing faster than users, which is amazing to see. And it's a huge underpinning, in my opinion, to what they can do in the future. Okay. That was a lot. But it's going to give us a grounding for when we forecast. Let's take a look at cash flow. Make sure cash flow is strong. Then we'll come back and forecast EBITDA. So behind me is their cash flow. Again, we reviewed this when I showed you the three parts of the cash flow statement on their 10K, but I want to talk to it in detail here. So I can pull numbers from 2012 all the way to 2019. You can see $1.5 billion of cash flow that they have generated to $4.5 billion in 2019. That's a 17% annual growth rate. That annual growth rate dovetails nicely with the EBITDA, the 16 and change percent growth rate of EBITDA. That means that the finance and accounting team are reflecting cash costs in the P&L and the income statement are also being reflected in the cash flow statement. It's a good smell check for the accounting department. So kudos to them. Next, CapEx. CapEx is the money they have to put back in the business to sustain the business, to make sure the computers are up and running, to make sure the networks are there. If they're migrating from one system to another one, that's CapEx. That's a must. So when I look at the difference between these two, that's how I get free cash flow, and that's what on their statement when they said free cash flow for Q3, I said was strong in the very first part of this video. They're taking these two numbers. They're taking 4.5 and minusing $700 million, and that's the cash flow number that they give you. And this is strong. If they generated $4.5 billion of cash operating the business, it's in the bank account at the end of the year, all the bills are paid, this is what's left over, well, then they have to put back for reinvestment. After that, that's a small number compared to this. What's this, 20% of this number, roughly? Rough math, very rough math. That means 80% of the money is left over, and that's a huge, huge chunk, and it passes through to cash flow to the equity holders, which is you and I if we choose to buy the stock. The next piece that we look at here at this channel is debt payment. Now, if a company has a lot of debt, it's really impactful to the cash flow to equity because you have to pay the bank back, and that's critical. Here, these guys don't have much debt. We covered it, it's zero. So this number is them borrowing for other investments. We're not going to include this in our long-term forecast because it's a one-time blip. And in general, they have very little. So most of this cash flow here passes right through to the equity holders, which is what we're buying. So when I look at this business, I'm looking in this range here, where they didn't borrow much debt at all. And most of this passes right through. I then come over and look at the share count. which I showed you earlier, comes from the income statement. Down below in the income statement, typically in every company, it'll say weighted average diluted shares outstanding or weighted average shares outstanding. I'm pulling that number. This is your percentage ownership essentially in the business. And I divide free cash flow to equity, divide by shares, and I get free cash flow to equity per share. This is the foundation of every company and what it's worth. It is what has it done in the past and what do investors think it's going to do in the future. That's what we're buying. This is what we value businesses on. And you can see it's averaging, I think that's an average of $3 here. And it spiked up to $5.80 because of this large borrowing here of $3 billion. So I'm not going to use this year. I'm going to average these to be conservative around $3, and I'm going to grow that forward when we grow EBITDA, assuming that the margins hold the same. You got EBITDA is going to flow through the cash statement. Last thing, shares outstanding. The yield and the return on equity. So yield is basically just the free cash flow equity per share divided by price. Gives me a yield, a cash flow yield. This is just like a multiple. It's just an inverse. So the higher the yield, the lower the multiple. And then return on invested capital, which is small. It's at 11%. All right, let's forecast forward EBITDA and figure out what we think the stock value for PayPal is. Behind me is the estimate of 2020 EBITDA. That's $4.3 billion of 2020 earnings. And that is based on the Q3 report that we saw earlier at a 25% growth rate year over year. And what I'm doing is I'm stretching that growth rate out. Why? Because I believe the combination of active user growth that we have seen over the last multiple years at double digit, and those users giving PayPal a greater piece of their wallet, meaning the total payment volume is growing faster than active users, I think that was going to be able to sustain them as this whole business continues to grow. They also are going to be expanding into Bitcoin, allowing people to buy, sell, and hold Bitcoin within their portfolio. And I think that'll help bring in more and more transactions that they can clip little nickels and dimes on. So I think this is a aggressive but plausible forecast for PayPal. So a target of $20 billion in 2029. I then give that a 20 times earnings multiple to come up with an enterprise value of $400 billion. I subtract the tiny bit of cash, debt that they have. I add some cash, and I get a market cap value of $411 billion. I divide that by the outstanding shares that they have, and I get a price target of $350 based on a market multiple approach. All right, now let's go back and take a look at free cash flow, forecast that, and come up with a cash flow valuation. Here, 2020 free cash flow of $3 per share. This is me averaging the 17, 18, 19 years to come up with $3 a share. And I'm growing that at the same growth rate, assuming that that EBITDA will flow through the P&L and they don't make any huge changes to the way they spend their cash. I get a long-term forecast of $14 per share on a free cash flow basis. What I then do is I make that a 3% yield, and I get a $473 price target on a cash flow basis. Okay, now we have two valuations, one on a market multiple, one on a free cash flow basis. Let's average the two for what we think the business will do long term and see what the IRR looks like. So here we go. I can buy the shares today at $213 a share. I've got two price targets, $473 and $350. I'm going to average the two because I don't know. This gives me kind of a range. I'm at $411 per share for a long-term price target. If I put this into an IRR calculator, I get my stream of cash flows, $3 to $14, which they can dividend, they can buy back shares, or they can hold on the balance sheet, or they can do whatever they want with it. But we're going to count it as part of our investment because it's ours. We'd be a shareholder. I buy in for $213. I'm out at $411. I get this stream of cash flow, and that IRR is a 10% IRR over the decade, which is market. It's not stellar, but it's not single digit. It's a very market rate of return, which makes me believe that PayPal is currently fairly priced on their stock because it's giving me what is a market return on the investment. That's basically 2.3 times the return on cash over that decade. If I put this into an IRR distribution chain, what I get is I'm buying it at 214, roughly, 10%, assuming this math exercise that I just did pans out. If the share price falls to $565, that's a 15% IRR if you're able to buy it at that point, which would be amazing. If it goes north, it gets smaller IRR as the stock price increases under this same scenario. So that gives you a little bit of range. So I think the upside here is pretty decent. On a price target, you've got $411. You're buying it. That's basically 2 times your money over that decade. I want to show you something on the downside. So if you bought in today and for some reason the market just goes away and people run away from the stocks come down, how far down could it fall? Let's take a look. We look at cash flow in this channel, right? That's the foundation for all investment. Market multiples, yields, those are kind of the art aspect of the blend between art and science that is finance. And they can be very behavioral finance driven, very fad-like. And the market multiple is definitely that. It's definitely hot at 60 times earnings, where it used to be around 30 times for multiple years, and suddenly now it's 60. Well, what happens if it were to go back down? What would that price be? Let's take a look at that. We'll take our average historical EBITDA. We'll multiply it by our estimate average multiple times the EBITDA to get an enterprise value. That enterprise value is $125 billion. I'll subtract some debt from that, and I'll add the cash to give me a market cap. And then what I'll do is I will divide that by shares outstanding to give me a price. Just let me quickly do this for you, shares. So that means that the share price, should the market revert back to what it has been historically, the share price will collapse to $105, which is a steep 50% haircut from where it is now. So when I look at the stock market in general, I see a fairly to richly valued market. And when you put cash to work in this market, you need to be extremely careful, because if it did collapse, you would not sell out, obviously, because there's value here. This business is very, very good. But you in a loss, so you'd have to end up having to hold it from this point through the decade that we forecast till it finally gets to our long-term price target, $411. So I think that means that if you buy now and it falls, you're going to have to stick in and wait for it. The other thing I want to show you is the market multiple, how it affects the long-term price, right? So in this example, when it's just the EBITDA piece, I've got a $350 price target because I have a 20 times multiple. If I put that back at 30, that's a 500. So that's an extra $200 increase on the price target by moving this multiple. So there's a lot of variables here that have nothing to do with the earnings and sales growth. This is the behavioral finance piece that is often overlooked outside of the math piece of what is financing. But I want you to be aware of that. So then what do we do with this investment? We've got a forecast which is basically market at 10%. You've got a downside risk, I think, which would be halving of the stock value, which would be a significant loss. And then you've got some upside here if the market multiples maintain. That 350 could be 525, could be some upside. Let's just summarize all five. So top line revenue growth, yes. Earnings growth, absolutely at double digits. Free cash flow is strong and growing. Low debt, yes. Well priced, yes. So what rating do I give this? What do we want to do? I'm going to give it a good. Yeah, that's right. We're doing a good. Why? Because I like the upside. The base case for me is a market return at 10%. If the upside catches, I get a stronger market multiple because my 20x is pretty conservative. I go north. if they're able to accelerate some of the bigger things like Venmo or Bitcoin, or they've got a pay later aspect that people can transact now and then pay over 3 or 4 payments, I think those are good upsides that could lift this above 10%, and I want that in my portfolio. Certainly, if I look at holding my positions 10 years from now, the base case is that 10 years is going to be higher, going to be $400 a share roughly. I'm still making good money, and I've got good upside. If it should collapse for some reason and revert back to the average it has been historically on the market multiple, and I can pick this thing up for $100 a share, I'm all in, right? So that's when you would just kind of back the truck up and buy more. But I do like it right now. Obviously, I would love it if it was cheaper, but I think at this price, it's fairly valued right now. And this is my blog. This is how I look at stocks and where I put my money. And I think for right now, I'm interested in buying this stock, and I'm going to take a serious look at it here in the next couple of days. But I want to thank everyone for this channel, for bringing this to my attention. I wish I would have looked at it 6 months ago, but there's just so much to look at. It's hard to stay focused on everything. Comment, subscribe. Let me know what you think of the channel. Definitely dive into the comment section. People are suggesting some amazing stocks, and if you like what they are suggesting, you want me to do it, continue to ping the same company, and it'll bubble up the surface, and I can go after it. But my name is Cameron Stewart, CFA. This has been Rational Investing. Thank you so much for watching. Please hit the subscribe button, comment. It's been a great run. Thank you very much for your time. Goodbye.